Guys, what is going on? Happy Friday. Welcome back to another Dividend Happy Hour. Let me tell you, just right off the bat, how excited I am to be here tonight. I have been looking forward to this live stream not only all day, but all week. So I'm stoked to be here with you guys. Hope everyone's having a great week. Today was a really good, I don't know about you guys, but this week was pretty red. Did a lot of buying this week. I'm going to be talking all about that in my video going out first thing tomorrow. So I'm not going to spill any of those beans tonight. I really went heavy in buying really these last few weeks, but I'm going to be telling you all about that in tomorrow's video. Really making some great strides as far as dividend income goes. Today was a crazy day in my portfolio. I think I was up, let me see, basically 1.25%. Most of which just came from Clear Secure. I think Clear ended up seeing like a 12.6% gain or something like that for the day. So really good way to close out the week. Like I said, I hope things are going well for all of you. We did start a couple minutes early. I was just too excited. I wanted to get it going and just see you guys. So let me see who we got here in the chat. Let me just scroll up to the top here. I see a few of you guys dropping some comments here in the live chat before the stream started. We've got Thrawn, who's looking forward to another happy hour. Amir, this is awesome. Excited for the stream. Been loving the Discord community. I'm so glad to hear that. And by the way, if you guys are not in the Discord group, please join. It's just, I think there's over 3,500 members in there right now. It's free to join, and it's just basically one big group chat filled with other dividend investors or just investors in general, talking about stocks and investing 24/7. There's a link to that in the description of the video. I hope you guys check it out. And also, it would mean the world to me if you'd give a thumbs up on the stream. I never ask. I always forget to bring it up. But guys, it really does make a big difference. Do like Korean Cardboard here said, hit that like button upon entry. Please do so, all 65 of you guys. Let's see how many people we can get in the stream tonight. We are 65 strong so far. Amir also said, people in the community have provided me with very intellectual conversations, and I'm glad to be a part of it, man. I'm so stoked to hear that. And I'm glad you're having a good experience. Let me see who else we got. Chris is here. Pat's here. Fast Eddie, what is happening? Shannon's in the building. Gillo's in the building. Alfredo's here. Vasco. My man Paco's here. What's up, Paco? Lopez Productions here. Chavon picking up some Zoetis. Good move. Yeah, that was a tough one this week. Tough one. I'll be talking all about that once again in tomorrow's video. Don't want to spill the beans beyond that, but I spent a good handful of minutes talking about Zoetis and what I'm doing with it. So, and what I've done with it so far. So definitely tune into that, guys. I'm really excited for that video. Caesar's here. Phil's here. Edgar. Seth, this is a good question. What is your opinion about ADP after its fall from the last month? So funny enough, I was actually looking up ADP last night or 2 nights ago. I was just checking it out because I'd seen that the share price dropped quite a bit. So we'll take a look at this one on Snapstock. And with that said, if you guys have any stocks you want to go through, any investing questions, drop them here in the chat, and we'll go through them here in the Dividend Happy Hour. Let me see. Who else do I see? I'm all caught up in the chat here, basically. QED's here. Jose. Lucas. What's up, Lucas? David's here. Vinayak's here. Sel. Good to see you guys. Yeah, it would be interesting to talk about Maine and Blue Owl Capital, the difference in similarities. Well, I can actually answer that one right now. The similarities is that they're both business development companies, so they both lend money and invest in what are called middle market companies. And basically these middle market companies are businesses that are maybe too big to go to your local mom and pop bank and get a loan. But they're also too small to get more substantial financing. So they're somewhere right in the middle. And that's where these business development companies come in. If these middle market companies need financing, they can go to a company like Main Street or Blue Owl Capital Corporation or any other BDC who specializes in lending or investing in the companies in kind of that stage of the game. So that's how they're similar. I would say that the main couple of differences between Main Street and Blue Owl Capital Corporation is that Main Street is what's called an internally managed business development company. So the management team handles the fund from within. Blue Owl Capital Corporation is an externally managed business development company. So they outsource the management of the BDC to a third party. Those are two differences right there. Or that is one difference, I should say. Another difference is just in their portfolio. So, and you can look up and compare in their investor presentations through their investor relations website, just the type of businesses they loan out to, and how that is different. But I would say the main difference between them is the internal and external management. So let's see. What was I going to do? I don't know. I was all caught up in the chat, but now I see some more you guys popping in. DG's here. Thoughts on Google? To be honest with you, I don't really have a serious opinion on Alphabet. Yeah, it definitely feels pricey compared to this time last year. That's because it's jumped up a lot. Actually, let's see if we can check it out. Let's go over here to Snapstock, guys, which you can start using for all of your stock analysis and research. There's a link to Snapstock in the description. So yeah, I mean, it's definitely more expensive compared to this time last month, to the tune of almost exactly $100. It's up 55% in the last year. So, and the free cash flow yield is very low as well, by the way. So yeah, I don't know. I don't really have any crazy thoughts about Alphabet beyond that. It's been an incredible grower, obviously extremely profitable. Debt's just not an issue. And it's, so far it's been an okay dividend grower, I suppose. We'll see how it shakes out in the coming years. But the main thing about this company is just the growth from top to bottom has been pretty substantial. So they're just printing cash. As far as the valuation, yeah, I wouldn't blame you for not wanting to buy it at current prices, but it's a great company, no doubt about that. Danny's under the weather. I'm sorry to hear about that. Hope you feel better soon. Who else we got? We got Joey's here. Let's see. Oh, you meant the difference in earnings. To be honest, I haven't gone through either of their earnings yet, so I really can't speak to that. Unfortunately, I haven't had the chance to go through them. I've got quite the list of companies that I need to go through. Maine's on there, Blue Owl's on there, Clear Secure's on there now. What else do I have? I've got EPD, Chevron, AbbVie. I already said Chevron. Those are the big ones, but the main ones that I really want to go through soon are like Clear Secure for sure, Main Street, and Blue Owl. Those are the top three. So yeah, I can't really speak on the difference in their earnings because I haven't gone through them. The one thing I do know is Maine's net asset value went up. Blue Owl's net asset value went down. Actually, I guess I do know a couple of things. Other than that, it looked like on a very surface level, the NII, the net investment income or interest income, whichever, for Blue Owl was like barely covering the dividend. So they're not going to be paying, or they shouldn't be paying, a special dividend in this upcoming quarter, as opposed to Main Street. I don't know what their NII came out to be, but from what it looked like, they still plan on keeping their 30-cent supplemental dividend in the quarter ahead. So I think that's good. Let's see. Billy's here. JJ, what's happening? David. Yep. This is a can of worms. We're not even going to touch that one. I'm just not a fan. Generally speaking, not a fan whatsoever. Avoid at all costs. I'm just going to leave it at that. Because it's a can of worms, I'm telling you. It's like a trigger, I see the word yield max and I just start seeing red, like minor threat. Let's see, let's keep going though. I got some questions for you guys. I mean, why don't we kick this thing off? I'm pretty much all caught up here in the chat. Lashinsky's here. We're just going to call you Lashinsky. What's happening? Thoughts on PACCAR? Yeah, we'll check that one out. Big fan of that. This is a good question from Amir. I've actually been thinking about this a little bit. Earlier today, I was thinking about it. Yeah, as far as having Ari on the dividend happy hour, he's 9 hours ahead of me right now. So it's like 2 a.m. where he is right now. So it's definitely too late for him. We'd have to do another live stream, but we do the deep end every week. So it pretty much, if we're going to do something together, we'll just do it on the deep end. So I have not gone through Clear's earnings yet, so I really can't speak to them. It looked like they were seeing some growth. Are you buying Blue Owl now at 1206? I'm thinking about it. I did pick it up at somewhere in the 12s not too long ago, maybe in the 13s it was, but I did recently buy some. There are 3 other companies that I'm actively adding to right now, though, that I think I would rather put that money towards. And once again, I'm going to be talking all about that tomorrow. But if I wasn't kind of dedicating my contributions to those 3 companies, Blue Owl would definitely be in the running for sure. Yeah, is BMI attractive? I think BMI is attractive. That's Badger Meter. They put out some great earnings actually. Um, sorry, I'm just looking at the chat now. Yeah, BMI I think is looking pretty attractive. The share price just cannot catch a break. I'm actually surprised that I think it went down after the earnings. Let's look at BMI actually. Let's go back over to the screen. Let's do this right here. So no, I guess it's up. It's up a little bit in the last month, up 7%. So it's done okay. But yeah, I like Badger Meter where it's at. This is one of those, like I said, where it just doesn't seem like the share price can catch a break. It's down 11%. Things are looking good there. Yeah, wouldn't Maine first cut the quarterly supplemental? Yes, they would sooner cut the supplemental dividend, which is basically a bonus dividend. We can just different names for the same thing. We can call it a bonus dividend. So yes, they will definitely stop paying that bonus dividend before they keep the regular monthly dividend going. So yes, good observation there. Yeah, that's a good question. I've been considering doing business with Limits Express, and already in which who is the company that manages my Walmart WFS store, and I already had an interview, but I want to know what you think about the integrity of the company and you trust them apart from sponsorship. Yeah, I mean, I have a store with them. I regularly contribute money to continue running this store and buying more inventory, and it's been a great experience. I mean, just like anything else, it'll have its hiccups, but those hiccups haven't been because of anything sketchy on behalf of Limits Express. The issues that I've had are like shipping delays or like Walmart not fully receiving all of my inventory, like Walmart losing my inventory. So those have been kind of the issues that I've had running my store. But I mean, working with Limits Express has been great. They're very communicative. For the most part, all of the products that they picked out for me have been good. There's been one product so far that is not selling, but everything else has been good. And I think that just kind of comes with the territory. Just like with investing, not every single stock you pick is going to be a winner. Not every single product that they pick out is going to be a winner as well. But it's definitely been more good than bad. Integrity wise, I've got no questions there. So yeah, they've actually been really good to work with. So yeah, so I'm sorry guys. We've got to get to our usual questions. Before we do anything else though, now 11 minutes in, and now that we're all caught up in the chat, grab whatever it is you're sipping on, guys. Cheers. Here's to you guys. Thanks for helping me make this another fun live stream, another fun dividend happy hour. Stoked to be back with you guys for another week. And also here's to the dividends. Here's to the pursuit of that sweet, sweet cash flow. Here's to the pursuit of financial freedom as well, because that's really what we're all after at the end of the day. We are on the journey to financial freedom together. So cheers to that. And here's to you guys. Ooh, that's so good. Okay. Guys, let me know a few things here in the chat. Number one, I want to know, some of you guys have already answered this preemptively. I want to know, what did you buy this week? Which stocks did you add to your portfolio? I said this earlier, but I went on quite the shopping spree this week. I'm probably going to go on another shopping spree next week. So it's been a good week as far as buying goes. So let me know, number one, what you bought. Number two, I want to know what you're sipping on, if you brought anything to drink to the Dividend Happy Hour. I just got me a little peach fresca. It is Fresco Clock over here. Number three, I want to know if anything cool happened to you guys this week in the portfolio. If you hit any milestones, anything crazy going on. Maybe you hit your 100th share of SCHD. Maybe you are, maybe this last week, between last week and this week, you had your best month of dividend income ever. Anything cool that happened in your guys' portfolio, I want to hear about it here in the chat. And also number four, I want to know if we have any first timers here in the live stream. In case this is your first time tuning into the Dividend Happy Hour, we are now 153 episodes strong. And we do this live stream typically every single week, Friday night, starting at 5 p.m. Pacific time, 8 p.m. Eastern time. It's always a good time. It's always a random time. It's just kind of our chance to get together, hang out, shoot the breeze, and see where it goes. There's really, as you can tell by now, there's really no plan. There's no agenda for this live stream. It's just pretty much hanging out with you guys and seeing where the conversation goes, which I think is the best part about it. So Let's keep going. Let me scroll down here in the chat. Looks like in no way affiliated. I'm investing in ammo and silver. There you go. Good stuff. Let's see. Yeah, Amir, I saw in the Discord we have a personal finance chat. Just wondering, have you ever been interested in posting content related to personal finance, like not things specific to stocks, credit cards, savings accounts, stuff like that? Not really. I don't know that I have too much to say about that. The only thing I really have to say, I'm not like a big credit card guy. I don't try to like max. I'm not trying to like hack the credit card game or anything like that. I'm really not interested in that. I've got 2 credit cards. I only really use one of them, and I'm just not really that interested in continuing to open up new cards just based on the perks. It's not my interest. I'm pretty fond of high yield savings accounts though, and I do have one thought on that while we're on the subject. I for the longest time I had my account over at Ally Bank, which has been fine, but I just recently, within the last, I mean, you guys probably know this, within the last few months, I switched that over to Public, and now I'm using their high yield cash account, which has been great. Really, really good. Right now it's at 3.6% is the interest rate. And I'm really loving using Public. I have my Roth IRA over there as well. But beyond that statement right there, I really don't have much to say in terms of personal finance. I can talk budgeting if anyone wants to, has any budgeting questions or anything like that. That is something I'm interested in. I don't know that I'd ever make a video out of it or make it a topic here on the channel. But if you have any specific questions, I'm happy to try and address them. So. Yeah, let's see here. Edgar bought some SMHX. What is that? SMHX. Okay, it's a semiconductor ETF. Nice. Okay. And you know what? Kind of on this note, someone asked me in a comment if it's a good idea to buy something like SMH, which is another semiconductor ETF. Actually, I think it's a Van Eck fund as well, right? SMHX versus, oh no, yeah, they're both Van Ex. I wonder what the difference is between those two. But anyway, someone asked me if it's a good idea to buy these types of ETFs that are kind of like industry specific like that. And I think if you want exposure to that space, if you specifically want exposure to the semiconductor industry, but you don't really know a whole lot about it, like myself, definitely a simpleton when it comes to that, I think that these types of ETFs can be a good way to get that exposure. So I'm for it. Let's see though. Yeah. Excuse me, Vici under $30 was a blessing. I agree. Oh, interesting. Oshkosh does armored vehicles. Okay. And industrial / residential constructional lifts worth a peek. We'll check it out. We'll go through their financials. I don't know that I ever have. Yeah, we'll take a look at it. This at a glance, it looks interesting. Okay. Ooh, some grape Fanta. Nice. Love grape soda. Gillo bought some Meta. I see Tharson with some Webull Realty Income and SCHD. Nice. Ooh, Korean cardboard. That sounds like a party over there. Drinking latte and eating pastries. Good. Yeah, Caterpillar has been absolutely stellar. Great company. Really, really solid company. Chris, been making some big moves in the portfolio lately, man. I feel like every week there's like either a new sell or like a new addition to the portfolio. But anyway, picked up some of the usuals: VOO, Walmart, and Visa, and then also some Meta, which is a new position for him. Sold out of SLV to put into Meta. Okay, nice. Gillo bought some MD. Yeah, Jose's first time in the live stream. Well, welcome aboard. Hope you enjoy it. Let's see. Yeah. Oh, yeah, that's nice. Super nice. If it's the first time, you're in for a treat. Amir, you're too kind. Andres picked up 200 shares of SCHY. That's the international ETF, right? That's like the international SCHD. Yeah. Okay. It is. Gillo picked up some MasterCard. Yeah, PACCAR is a solid company. Yeah, how are you making out with the book club book? I've actually finished it. I have it right here. And I don't know if I brought this up last week, but over on the Deep End, Ari and I are doing a Deep End book club. This book right here is the first book we are reading. And our plan is to, and for anyone participating in the book club, is to read it start to finish by the end of November. Sometime early in December, we're going to get together. Anyone who wants to join, by the way, is welcome. It's totally free. and you just have to read the book. That's like the only requisite, because we're trying to take it serious, you know. We're going to do a big Zoom call so we can all get together and just talk about the book, go over some of the themes and takeaways and stuff like that. And then after that, Ari and I are going to try and get the author on an episode of The Deep End. So we'll see how that goes. But yes, we are starting with this book right here, which is Retire Often. I already finished it, and I still need to take notes. I've got probably 10 to 12 quotes that I pulled from the book that I really want to, I really need to like start going through. And when I read, I don't take notes on every single book that I read. Most ones like this that are, how would you describe it? I want to say like instructional, you know, ones like this that are more instructional. I do tend to take notes on this one right here, The Dividend Imperative by Daniel Paris. I'll probably take notes on this, but I just started reading another book, The Richest Woman in America. I don't remember who the author is, but it's a biography of Hetty Green. I won't take any notes on that, but what I was going to say, that's more of like a casual read. I'll still learn something and get something out of it, but don't really need to take notes on it because it's more like story driven. But anyway, what I was going to say was the note-taking part of reading books for me is the part that takes the longest. I can read pretty quickly, but I have to like slow myself down because I don't want to get too ahead of my notes, because then the quotes that I will have pulled that I want to take notes on will they'll kind of lose their spark. So I need to like temper how much I'm reading when I am reading books where I'm taking notes. And with that said, that's why I try to balance out between books that I take notes on and books that I'm reading just more casually, so I can just kind of, you know, read at my discretion. Says some big shopping spree this week. Visa, DGRO, SCHD, Vichy 100 shares. Wow, big buy. FX, AIX, nice. Law, no buys, but Pepsi's good. Okay. Yeah, seriously, Snap-on with the 14% increase. That was awesome. Okay, guys, I'm going to scroll down. I'm going to scroll down just a bit and get caught up here in the chat. Interesting. Okay. 22 with 75% of my net worth in my Canadian tax-free account. My emergency fund is comfortable. No car, but no debt. Is this overexposed? I don't, what do you overexpose? What do you, I'm tripping over my words. What do you mean by overexposed? Sounds like you're doing great to me. All of that sounds good. But yeah, what do you mean by overexposed? Yeah, Daniel wants to go through Morningstar. We'll do that. Okay. Ooh, Star Bulk. I think I've looked at that one in the past. What is that? Is that what it's called? What's the ticker on that one? I think I know what you're talking about, but I'm not seeing Star Bulk. Okay. El Dynamico. What's up, Antonio? Okay, guys. So we've got five questions, 5 stocks that we need to go through. Let's just start here. Let's just start here at the top with Seth. Seth wants us to look up ADP, which is automatic data processing, after its fall for the last month. So from what I read about ADP, which if we go over here, so let's see the drop here. Okay, so ADP is down 12% in the last month. Pretty big drop. Well, no, it's not too crazy. Nothing too crazy, but you can see it did drop right here, and I'm guessing this is where they reported earnings. So down 12% in the last month, down 11% year to date. And I just want to preface this with, I don't really keep super close tabs on this company. In the past, when I've looked at it, I've liked it. It's just always been very expensive. It doesn't look too bad right now, though. The free cash flow yield's 4.5%, quite a bit above the average. The PE ratio is down to 25, which is a bit below the average. And from my understanding, from what I read, I think one of the big, and let me know in the chat if you've got any insight on this too. You can help me fill in the blanks here. Looks like Tom has something here. So let me pull this up first. So I presume ADP had a $9 billion write down in the previous quarter, and they took on $4.7 billion of debt to avoid running out of cash. Decent looking growth otherwise on first inspection. Okay, so maybe that's it. And that's the insight I don't have. But from my understanding, like one of the big concerns with ADP is maybe the softness in the job market. We're seeing that really have an impact on Robert Half, which is a company that I made a full video on recently. That stock's just been getting butchered. But a softer job market, as well as concerns possibly over AI replacing certain jobs. And if AI replaces certain jobs, there's not as many jobs. ADP won't have as many employees to have record for these businesses, which are their customers and clients, to keep track of. And so that could negatively impact their sales and earnings. So long story short, less jobs or softer job market potentially negatively impacts a company like ADP. And if those jobs cease to exist, then that's also not good for them. So from my understanding, that's one thing that is not working in their favor. Tom or anyone else, let me know if I'm have that right, if I'm missing anything on that. But that's kind of my take from the brief amount that I've read about it recently. Yeah, Jeff's here. What's up, Jeff? I'm surprised this is your first time in the live stream because I know you're a longtime watcher. So, man, thank you for tuning in. Happy to see you here. Yeah, so they look to ADP for the job reports. Many big and small companies using it. Yes, yes, yes. Coach Tim in the building. So anyway, going back to ADP, everything aside, share price drop aside, it looks to be a pretty high quality company from top to bottom. Like nice growth, nice profits, solid debt, looking good in the dividend department, strong capital efficiency. What do we have here? Yeah, Stan says ADP is getting butchered because insiders are selling like crazy. Okay. So anyway, Snap score looks really good. 7.7 out of 10. Really great. Looking at the growth stats, I mean, from top to bottom, its growth is very consistent. And just because of what they do, a lot of their revenue is subscription based. So it's no surprise to see this revenue consistently going up over the years and also the bottom line going up as well. Because a lot of their revenue, I don't know how much is, recurring. So that's good to see. And it's grown at a pretty aggressive rates over both the 5 and 10-year period. I mean, the bottom line's grown a lot faster, actually, which is why we'll see interesting gross margins are going up. That's great. But this is also why we see the net profit margin going up. So really solid increase in margins over the last 10 years too. So that's improving. Looks like debt saw a decent jump in the trailing 12 months, but still they have more free cash flow coming in per year than they have debt on the balance sheet. So it's not like a huge ordeal. Let's see if I missed anything here in the chat. No, we're good. Everything's good. So I'm not that worried about debt. Interest coverage still looks pretty good. And now let's get into the good stuff, the dividends. So it looks to me like the dividend yield, at least based on the trailing 12-month payments, it's not too far off from the average. It's a little bit higher, 2.25%, pretty decent yield. But I think paired with the dividend growth rate, about 12% over both the 5 and 10 years, I think that's pretty spot on. Those are going to be your pretty typical dividend growth stats, classic dividend growth stats. And actually, the increases over the last couple of years have been really solid, like mid-teens. So while simultaneously the payout ratio looks to be consistent, earnings payout ratio looks to be consistent, and actually the free cash flow payout ratio has been going down while they're also buying back shares. And also, as we can see, very strong returns on invested capital, actually like 40%, pushing 40% over these last few years. So at least at this high level overview, I think ADP is looking good, and it's definitely worth further consideration. So, but Tom here said, I looked at RHI as well. They took less operating cash flow and cut their buyback rate in half in the last 2 quarters. If operating cash flow dries up further, the dividend could be next. Yeah. And what did I say? I'm already forgetting, but I think that I thought it still looked pretty covered based on the free cash flow. So it is, but the free cash flow payout ratio definitely jumped up a lot this last year. And actually the earnings payout ratio substantially jumped up. So yeah, that is definitely something to keep an eye on. I will say the good thing about them is they have negative net debt. So there is more cash on the balance sheet than there is debt. But yeah, the free cash flow definitely took a hit this last year, and earnings have as well. That's kind of the big. You're right. Like the dividend kind of is the big question mark. And, in the meantime, though, getting pretty nice yield. So, but anyway, that was ADP, and I guess Robert Half a little bit. What else we got? Let me go back over here to this next one. So we looked at ADP. Yeah. Next up is PACCAR, and this is a company. Man, I talked about them, I don't know how many months ago, but I think I put them in one of my, deeply discounted dividend stocks. Actually, if we go over to my website, they were one of my top dividend stocks to buy. Let me see when it was. They were my top dividend stock to buy in July. Yeah, in July. So I really like PACCAR. And by the way, guys, while we're here, I don't know how many of you read the newsletter or check out any of the articles, but I'm publishing over here every single week. And if you go here to retirewithryan.com, you can get all of my articles sent to your email pretty much every Thursday morning. And with that, I'm also sharing weekly portfolio updates, all my dividends, all my buys, everything like that. And there's some other good stuff in the newsletter as well. So definitely check it out. But going back over here, we got to jump over to PACCAR. Okay, we're already over there. Let me take a sip real quick, actually. Take a quick swig. Ooh, Dividend Master. Interesting that the Dividend Master is trying to convince me to change to growth. I never understand this. What's with the, just because I would think that someone such as yourself would understand this. I think that's a huge misconception that just because one buys dividend paying stocks that they are foregoing growth. I mean, I have plenty of solid growers in the portfolio. And I think this is another kind of like trigger thing for me, because it's a huge misconception that dividends or growth are mutually exclusive. It's just not true. It's just not true. But anyway, PACCAR is a great example. It's not been great over the last year, but over the last 5 years, up 100%. The dividend growth has been pretty tremendous as well. Look at that. Really nice 5-year CAGR, actually. But anyway, getting ahead of myself. So with PACCAR, decent snap score, a bit lower than what we saw with ADP. Goodness gracious. What is in this Fresca? So a little bit lower snap score, great growth. Like, we're going to see really solid revenue, earnings per share, and free cash flow growth. Low profitability score, which is no surprise. They manufacture like heavy equipment, heavy machinery. And in case you don't know what PACCAR does, they make the big semi trucks. Peterbilt. What are some of the other? What's another one of their brands? Peterbilt's a big one. Kenworth as well. So they basically build trucks, build semi trucks. That's what they do. Okay, so what can we say? Let's scroll down to the growth. Really solid revenue growth over the last 5 years, like 16% since 2020. They really rebounded. And even looking at the trend over the last 10 years, the sales have gone from 19 billion to about 33 billion. So that's a really, really solid growth. Earnings per share has been choppy, which is no surprise. This is going to be a cyclical business, just depending on, what's going on in the economy. But for the most part, or even generally speaking, I should say, the general trend is up and to the right. The earnings per share has grown by 11% over the last decade, 3 times as much over the last 5 years. And the free cash flow growth has been pretty solid in both time periods as well. So doing really good. Scrolling down, debt's decent amount of debt, 10 billion on the balance sheet. Net debt to free cash flow is about 4.4. So that's kind of like the upper end of where I'd like to see it. 5 is kind of my threshold. Interest coverage still looks good. We don't have the most recent year, 2024, but 2023 and prior, or these 2 years right here looked okay. With that said, decent starting yield, about 4% in the trailing 12 months. We already talked about them being a solid dividend grower. Over the last 5 years, it's 31%. And I wonder if there's some special dividends paid here. That's kind of what it looks like based on this chart, but or maybe they cut the dividend right here. So let me actually go over here and cross-reference this with Seeking Alpha and see maybe if I can get some more insight on that. You're trolling me. Okay, good. You're keeping me on my toes is what you're doing. Guys, this might not work on Seeking Alpha. This has been happening this has been happening for probably a good week, maybe 2 weeks now, where, oh my gosh, I feel like it just takes me a minute to load a page on Seeking Alpha, and it's just Seeking Alpha. I don't know what it is. Okay, well, we're going to forego that for now. I apologize. Payout ratios look pretty good. Nothing crazy there. Return on invested capital is really going up. So I like PACCAR. Yeah. Someone else said that too. Maybe I do need to give that a try. And I've done that in the past too, and I've still had this issue. But anyway, it is probably just me one way or another. So PACCAR looks good. I will say going through it again now, it's not as, and maybe this is just because we like following ADP, whose financials just look a lot cleaner, a lot better. This one, now that I'm looking at it again, it's not as exciting to me as it was the first time that I looked at it. So I think what made me first want to look at it is, I actually don't even remember. I shouldn't even say. But anyway, enough dilly-dallying. So let's go look at, Jack wants us to look at Oshkosh, OSK. And this one actually, well, we'll check it out. I'm not even going to say anything. Don't speak too soon, Ryan. Okay, so Oshkosh, like you said, they make armored trucks, they make residential and industrial lifts. Okay, so interesting business. I actually want to see if I want to go to their website real quick. Okay. So they are leading brands, JLG. Okay. You guys recognize any of these brands here? Anyone can anyone speak to any of these? Any insights? Okay, so oh, interesting. Is it a garbage truck? Yeah, okay. That's cool. That's actually really cool. And actually, I think I could be wrong, but I'm pretty sure the Republic Services is who I have for my garbage. And here in Las Vegas, I think it's just RSG. I think they use Peterbilt trucks, if I remember correctly. So we're double dip. We might be double dipping here. We might have a little Oshkosh in there. If they have their hand in this, we might have a little PACCAR. That's cool. Okay, but anyway, this is really interesting. Interesting. Fire trucks, you said Dividend Master, huh? Yeah. Okay. So I'll look through that more later. So once again, kind of like with PACCAR, no surprise that we're going to see a low profitability score. Overall score is 6 out of 10. Nice growth, decent debt. Dividends and buybacks are a bit low. Nice capital efficiency. So let's scroll down. Looking at the growth, pretty similar, I guess, to what we saw with PACCAR. It's had its ups and downs, but overall growth looks really good, actually, from top to bottom. Really nice revenue and earnings growth over the last 5 years. Free cash flow has been interesting. So they're doing about, let's remember this, they're doing about $4 to $5 in free cash flow over these last few years. And the dividend per share is about 2. So yeah, we're looking at about a 50% payout ratio or so. Debt looks okay, like big jump in debt in the trailing 12 months, but still the net debt to free cash flow is only 2.2. Interest coverage is 9.7. So that's looking good. Low starting yield. So, okay, low starting yield, 1.5% based on the trailing 12-month payments, with about a 10.6% dividend growth rate. So this is going to be, both of them actually are going to be a bit lower than what we saw with PACCAR. But it still doesn't look bad. A 1.6% yield, double-digit growth rate. Very, very consistent dividend growth over the last decade. Like there's really not much fluctuation here. So I think that looks really good. Yeah, and the earnings payout ratio is very low. Free cash flow payout ratio is increasing over the last few years, but still looks like there's plenty of dividend coverage there. and they're just getting double-digit returns on invested capital. So, yeah, it looks okay. Yeah, looks okay. I don't know. Kind of like PACCAR, I don't know. I don't know that this one really jumps out to me too much. It's not bad. Um, yeah, yeah. I think of Oshkosh Bagosh too. Okay, so next up, guys, we've got Daniel wants us to look at Morningstar. I think we're all pretty familiar with that company. What's the ticker though? Morningstar, MORN. Okay. Wow. Okay. So pretty big drop in the last year. Looks like the PE ratio is way below the 5-year average, and the free cash flow yield is way above the 5-year average. Okay. 4 red flags. So we'll see that as we go. Yeah, decent scores. Dividends dividends are low, capital efficiency is low, but the other 3 look pretty good. 6.3 out of 10. Yeah. Okay. So revenue growth has been really nice. Earnings per share, for the most part, has been good. These were a couple of rough years. I'd want to know what's going on there because the sales were still growing like nothing happened, but a big drop in earnings. So what happened that impacted their bottom line that much? We see it here with the free cash flow as well. So I'd want to dive deeper to know what happened there. But these couple of years aside, the free cash flow per share growth has been really nice. I do like that. Margins are pretty consistent. It does look like the net profit margin is kind of trending down. Yeah, kind of the free cash flow margin as well. I mean, since 2018, I know these years were down, but like remove these years and you still do see a bit of a downward trend with the free cash flow margin. So, once again, I need to spend a bit more time to get more acquainted just to know what's going on with the company in these years. Debt doesn't look to be too crazy. The net debt to free cash flow, yeah, 1.26, that's fine. Low starting yield, if this is right, which I don't know if it is, maybe it is. So, okay, let me get out of that. I was going to say, if this is right, this doesn't really look like that's appealing. Like super low starting yield, less than 1%. But the 5-year growth rate is only 1.7%. But I think that this year right here is screwing up the results. The 10 years intact, about 9, and that's pretty spot on with the 5-year growth rate over here, and the payout ratio is pretty low. So it's just something happened with this year here in the data. With that, though, the dividend looks very well covered, but these, how do I say it? For dividend stats like this, like a starting yield like this, less than 1%, I think there are way better businesses out there than Morningstar. If I'm going to be locking in a 0.75% yield, I would rather go with a company like Visa. Probably no surprise. You guys probably saw that coming. I would sooner buy Visa. I would sooner buy MasterCard. I would sooner buy, I don't know what Alphabet's yield is, but let's just lump them all into the less than 1% category. I would sooner buy Alphabet. I'd sooner buy Meta. Probably would sooner buy PayPal now that they just started paying a dividend. So there's a lot of other companies out there I'd rather buy, and ones that I think will have more consistent. I mean, the top line has been consistent, but more consistent bottom line and free cash flow with higher margins, with a net cash position, with more dividend growth, and also with like similar payout ratios and probably even buying back shares and certainly higher returns on invested capital. So it's not that Morningstar is terrible. It's just that I do think there are probably more interesting businesses out there, at least in my opinion. Darth, what's up, man? Good to see you. Darth, Dividend. Okay. So those were all of the stocks. We do have one more question here from Amir. This is a good question, actually. Just wondering, what do you do to get out of anchoring bias? I have so many positions I'm up on, and I just don't like buying more because my average cost is great. Yeah, and we've talked about this before here on the stream and in other videos. That's definitely one of the biggest mental hurdles that I think all of us investors have to overcome. And I mentioned this earlier, but I was thinking about this just earlier today. You know, one thing that I am kind of throwing around the idea of to also to overcome this myself is, and I think this is a very simple way that you can do it to overcome that anchoring bias, is just to turn your automatic drip back on. So basically, when a stock pays a dividend, just have it automatically get reinvested back into that same company. I'm kind of thinking about turning that on just for more simplicity, number one, but also number two, just to overcome that anchoring bias. I'm in a place where I feel like I have so many great companies. Let's use like Williams-Sonoma as an example. I love Williams-Sonoma. I would love to have more Williams-Sonoma. But to your point, you know, I'm so far up on that position, I just don't want to buy more. And so I think that dripping, like automatically dripping and reinvesting your dividends, is a good way to force yourself to buy more shares of those stocks that you're way up on. And so, like I said, I've been thinking about that. I was thinking about it earlier today, and I think that's something that I may do. Just turn the drip back on. And I initially turned it off because I just thought, you know, I could probably redeploy that cash elsewhere. But I don't know. I'm kind of reverting back on that, and I kind of like the idea of just automating some of those purchases and building up some of the positions a bit more in my portfolio that I really like Visa or Snap-on or AbbVie or Lowe's. I mean, you name it. I mean, even Blue Owl right now, you know, like I was saying earlier, I probably won't be adding to it myself because for right now, because I'm buying other things. Well, if I get a dividend that automatically goes back into it, well, I can just automatically average down. So I'm starting again to seek some of the merits of, you know, automatically reinvesting your dividends. So that's something that I'm really thinking about. And just to be a broken record, I do think that's an easy way to force yourself to overcome that anchoring bias. And maybe by seeing those dividends get reinvested to buy more shares at whatever price, maybe that will help you be more okay with doing it yourself. That's just a thought. And let me know if that makes sense to you guys. Let me know if you think the same, or if you also have any other tips to overcome this anchoring bias. So, oh, Jeff, there you go. Cutwater Tequila Paloma, a try. Yeah, I love Cutwater, man. Love their just love their margaritas, actually. I will say though, I'm getting lame, guys. As I'm getting older, I'm only 32, but I'm starting to hit the age where drinks like that really, even just one, really impacts me the next day. Like if I drink a Cutwater, I'm probably waking up with a hangover, even just one. Yeah, man says, I keep the drip on in my Roth always. Quality companies that I would not normally subconsciously reinvest into. Yeah. Dividend Master says, I just don't buy when the price doesn't make sense. And that was my initial thought that was one of my initial thoughts for turning the drip off. And I think there is something to that for sure. But it's also, I think it also can be beneficial to have some of that automation. And maybe this isn't going to sound good, but maybe it's good to not give yourself that blank dividend check to reinvest elsewhere. Maybe by reinvesting your dividends, you can potentially protect against another incorrect mistake that you might make in your capital allocation decisions. I don't know if that makes sense or not. Yeah, Jack, this is a good question. Thoughts on disaster restaurant sector right now? Wendy's, Chipotle, Shake Shack. I don't know what Eat is. And then DRI is Darden Restaurants. Yeah, it's been tough. I mean, you can lump in Starbucks there as well. I think Wingstop, well, I mean, Wingstop's been very volatile lately. I don't even know where it's at. Let me actually see. I feel like I've seen Wingstop. Um, oh, come on. There it is. Um, I feel like I've seen Wingstop. Let me just pull up the chart so you guys can see here. Let me close this out. Yeah, it was down, and I was talking about it back in here. I think it was also one of my stocks to buy in March. So my top dividend stock to buy in March, which means I would have published that sometime in like February. So right around here. And I guess it's still right there as far as the share price, but it's been on a journey. It's been all the way up to about $400 per share, almost 400, then back down to the 290s, then back up again to the high 360s, and now it's kind of headed back down. So Wingstop's definitely been on a journey. Yum Brands is another one that seems like it's been kind of choppy as well. It is up year to date. It's up 13%, so that one's done a bit better. But Starbucks obviously has had a tough time. Yeah, I don't know. I need to think about some of these a bit more. But it's kind of interesting. I think the whole fast food industry right now is pretty interesting. In the sense that the value proposition seems to be a bit questionable. Like, I think right now you could probably go to somewhere like, and actually this is my experience. I've experienced this firsthand. You can go to somewhere like Red Robin, which is not fancy by any means, but like a casual sit down restaurant chain like that. You can go to somewhere like Red Robin and get a better meal for a comparable price, and a better experience too for a comparable price than if you went to some of these fast food restaurants. And so I think that needs to change. Chipotle is still Chipotle is still a decent value. I still like Chipotle. Yeah, McDonald's is still, I think McDonald's is still a beast. Ooh, this is a great question. Um, so should you set your mind on small dividend income goals? Vasco, yeah, we can talk about Dollar General for sure. Let me save that here. We'll go through that one next and probably wrap it up after that. But anyway, should you set your mind on small dividend income goals or a big one, short term versus long term? If it doesn't make sense, don't worry. So I'm going to save this. This is a good question. So the short answer is both. I think you should have, big lofty goals, but those big lofty goals or those long-term goals are the culmination of reaching your short-term goals. So I think it's good to have both in mind. And my own example of that is like I want to actually kind of a medium-term goal. My next big goal, I feel like, is to hit $4,800 of projected annual income. I just hit 3,600, which is $300 a month. So 4,800 is going to be $400 per month on average. So that's kind of like my next medium term goal. And in the short term, I have other goals that I'm trying to reach beforehand. Like my next short term goal is to hit $4,000 of projected income. And, I think that like I said, I think you need to have both. And I think that having those short term goals and being able to check those off your box, I think those small victories are important, especially for something like this that does take a long time. I think that you need to have small, achievable goals that can help kind of stoke the fire as you go along and continue working towards those long-term goals. So definitely have both, and celebrate every small victory along the way, no matter what it is. Progress is progress at the end of the day. So, and every milestone or every benchmark that you hit is a reminder that you are on the right path and you are getting closer to the ultimate end goal of reaching financial freedom. But you can't get there without first, reaching those smaller goals. So my man Teeps is in the building. Good to see you, man. Way late. I blame the kids. Yeah, I hope you have a great weekend as well. And I'm happy to see you and appreciate you stopping by, even if it's just for a few. Good to see you, man. Yeah, can we talk about Dollar General? Yeah, let's talk about Dollar General. So it's been a while since I pulled this company up, or since I looked through it. I think I last mentioned it in a video sometime in 2024, and I think it's up quite a bit since I mentioned it. But it had a tough go around for a while. Oh, I mean, I guess it still is, huh? It's down 50% in the last 5 years. Really high free cash flow yield, really low PE ratio. Yeah, so the valuation's looking good, which is why it's become tempting. And this is where it gets interesting. So the sales have been really good, really consistent. Um, but the earnings per share has dropped off these last couple of years, and it looks like the free cash flow has as well. And I don't know enough about the company to know exactly why this happened. It does look like they really bounced back in the trailing 12 months, according to this. But yeah, this is definitely a big red flag to see that really big drop in free cash flow. And once again, I don't know enough about the company to know exactly what happened. But along with this, they've really increased their debt, while simultaneously their interest coverage has gone down. It's still above 9, it looks like, so that's good. But the net debt to free cash flow is sketchy. This is not great. But still, like, interest is decently well covered. So it's a bit spotty. It looks like the debt situation is a bit spotty. And is the yield really only 2.4%? Really? Yeah, I guess so. So 2.4% yield. It's been a solid dividend grower. They raised the dividend 30% in 2023, while the free cash flow took a big hit. Okay, that's not good. So, UPS did something similar too. They had like a really good year, like a really good couple of free cash flow years right in here. And so they raised the dividend something like 50%. They raised it just an obscene amount. And then the next year, their free cash flow really took a hit, and kind of like this. And the payout ratio skyrocketed after that. And that's kind of what we're seeing here with Dollar General. Based on the earnings, it still looks to be pretty well covered, and the free cash flow as well. It's not over 100% yet, but it's definitely higher than average, or higher than usual. And I mean, this was not great. So I don't know. I think that for Dollar General, and the returns really haven't been that great for Dollar General. I think the big question mark is, I think the two big question marks for me are the free cash flow and the earnings per share returning to growth, the debt situation, and the payout ratios kind of go along with the earnings and free cash flow. So uh, that's a bit questionable to me at this point. If I knew more about the company, I'd have probably more insight on that. That's an obvious statement, duh. But I just don't have enough insight on Dollar General to feel confident in where that's going. And I guess with that said, like, there are other grocery retailers I'd probably sooner look at, especially like the dividend stats aren't really anything special either. Like a 2.44% yield with like a low double-digit growth rate. I think there's plenty of other companies with more consistent financials that can offer those same dividend stats and probably better just total return potential as well. I think Kroger's a good example. If you're going to look at grocery retailers, I think Kroger is probably a better option. I think that although their net debt to free cash flows are really high too, and the interest coverage is low. But the dividend looks to be a bit better covered, and they're buying back way more shares. I think Kroger's probably a better option. I think Walmart's probably a better option as well, even though the dividend profile is totally different. Totally different. So I don't know. There's just better companies out there to me. Man, Stan has all the scoop on what the insiders are doing for these companies. Thank you for sharing this info, Stan. That's actually very helpful. And it's also, with that said, it is important to remember that there can be so many different reasons why insiders are selling stock, especially if the selling that shows up is just part of like their options. So I wouldn't throw the baby out with the bathwater just because insiders are selling stock. Let's see. And it's about, this is pretty good timing. So Random Games wants us to look at Accenture. I just recently looked at Accenture, actually. I did a full video on it. And if we go, let me pull up my stock pick scoreboard over here, because I want to show you where I covered it. So going over here, I covered Accenture, yes, back in my video that was my, like, where is it? So go over to my channel. It's 3 deeply discounted dividend stocks to buy in September. So I covered Accenture here. Spent a good few minutes talking about it. And since I talked about it, the share price is actually pretty similar. It's only down 3.7% since then. But and looking at the track record this year, guys, this last couple of months have been tough. But we've got some winners in here. Ross has been good. Clear Secure has been great. Clear Secure has actually been the top dog this year. FactSet's really taken a hit since I've talked about it. I've talked about FactSet a couple different times, but man, that stock has just been taking a beating. So, yeah, Mike, good time to start a position in Zoetis. $120 a share. I'm jealous. But anyway, guys, I think this is a pretty good place to wrap it up. We are just hitting the top of the hour. Before I do sign off for the night, I do have a closing question for all of you that I'd love for you to answer. Before I throw it out there, though, I guess I have 2 questions. Number 1, would you please do me a favor, hit the thumbs up on this live stream? It'd mean the world to me. It'd really help the live stream get out there a bit more, really help the performance of this video series. So do that if you haven't done so already. But number 2, I want to know here in the chat, it's obviously we're not even in the weekend yet, but going into next week, what are you guys going to buy? What are you going to pick up next week? Which stocks are you planning on buying? Let me know in the chat if you already have that picked out. Curious to know what you guys have your eyes on. Yeah, out of the stocks we've looked at today, BMI is the one that will go on my watch list. I don't blame you. I think that's a really strong company, very strong company. I think they have a net cash position as well. Random Games, thank you so much for subscribing to the channel and for leaving a thumbs up on the stream. Thank you. Vasco's going to buy some Visa. Looks like Seth with some Procter & Gamble and Wingstop. Anders is going with Mid-America and Realty Income. Nice. There you go. Big buys. Look at this. 10K in SEHD and 10K in Berkshire. Good job. Scott's going with PayPal. Harris family's going with AbbVie and IBM. Who else we got? Jeff going with SCHD and possibly Duolingo. Yeah, Dividend Master is going with Duolingo as well. Let's see. Coach Tim is buying McDonald's, JP Morgan, and Webull from a few. What is that? 10 PS. I'm not familiar with that. Was Clear Secure up so much from earnings or the TSA shutdown stuff? Yeah, they just crushed earnings. I don't know why it jumped so much today specifically, because I think they put out their earnings yesterday or 2 days ago now, but I would guess it's earnings related. Yeah, Lashinsky's going with ADP and Snap-on. Stan going with Zoetis, RXO, and BAX. Lopez going with Starbuck and Realty. Phil's going with SPGI. Okay. Nice. Trevon's going $100 in the UNH and Broadcom and 1 share of Louis Vuitton. Steady Bowl with some Realty Income in Amazon. Nice. Vacation time. Not sure yet. See what deals pop up. There you go. Mr. Mike, Blue Owl and Zoetis. Nice. Lashinsky. Hold on a second here, Lashinsky. What did you, okay, you said ADP Snap-on, but also WP Carry and MPLX. Nice. That sounds like a good shopping spree. Michael's going with Main Street. Tony doesn't know. Maybe Booking Holdings. Yeah. There you go. Law's going with more SHD and VOO. Good stuff. Yeah, Eric, good to see you, man. Getting some SPGI and SCHD. There you go. Is the newsletter free, right? Yeah, the newsletter is completely free. Once again, go to retirewithryan.com. You can sign up for the newsletter just right there as soon as you hit the website. And if you go over to the newsletter tab as well, you'll be able to, well, let me just show you. If you go over to the read tab, read up here in the header menu, go to read, go to newsletter. You can see all of these articles. All of the newsletters that get sent to your email, I post on my website as well. So you'll have access to all of those over on the website. You'll also, if you go over here, you'll see all of my stock research. I've been going hard with these quarterly earnings notes. You can see all of my quarterly earnings notes over here, all of my book notes as well. I think I've got like 20 different book notes up here. Something like that. So all my book notes, and I'm also going through all the Berkshire Hathaway shareholder letters and pulling notes from those as well. So I have from, what's the first year, like 1978, all the way up into 2003 done. So I am slowly but surely chipping away at all of those. But man, it's a mission. Hey, Lynn, what's cooking? David's just going to keep selling puts. Lynn's going to buy more VRT. Okay. Yeah, man says wait and see. Good stuff. Well, guys, with that said, I want to thank you so much for hanging out with me this last hour and some change. One thing that last thing I'll share with you before we go, I haven't gotten around to doing it yet, but hopefully by next week, I'll be able to do it. I've got some cool changes coming to the intro to the live stream. So when I first, go live, there's like a 60-second countdown basically. And I'm going to be making some fun tweaks to that moving forward. I don't want to spill the beans just yet, but something fun's in the works for that. I want to have a little bit more fun with it. So hopefully next week you guys will see a change there. But anyway, I just wanted to throw that out there, and also wanted to thank you guys once again for hanging out. Hope you all have a fantastic weekend. Next week should be interesting, as they all are. And what else can I say? Stay out of trouble, guys, and I'll see you in the next one. Take care.